Okay, welcome to a new conversation. Today, I'm really excited to talk to Adam Baron, who is the director and StarMine research lead at the London Stock Exchange. Welcome, Adam. And maybe to start off, tell us more about uh, what do you do at London Stock Exchange, what's StarMine, and what sort of things that you focus on.
Sure. Well, I mean, I always like telling people that I model for a living, but it's quantitative finance modeling, so it's not as fancy. But that's what we do at StarMine. We create quantitative finance models that we sell to hedge funds, asset managers, pension funds, and StarMine's been around since the late 90s, well before I joined. So, our biggest competition is usually internally because the decision is build versus buy. I mean, we have so many different models that are similar to commonly used factors or quite unique, like the Smart Holdings Plus that I'll be talking about. And, we just want to add more tools to what these quants have at their disposal as they're trying to find alpha and mitigate risk with, many different out-of-the-box models that we offer. And the models are more in the form of not interactive models, but more daily and intraday feeds that rank stocks relative to each other based on whatever the model is assessing.
And I think you talked a little bit about the motivation of building these models, but from a client perspective, how do they typically use these models? Do they use it in complement to their internal models? Do they use this as the main model, the StarMine models as the main models to help them drive buy or sell decisions?
Well, I mean, that's the thing. Our clients are very secretive, so they never tell us exactly how they're using it. But the fact that they keep paying their bills each month means that it's valuable. What I imagine is they're probably not using a single model of ours in isolation. They probably have their own strategy, and in combination with their strategy and our model, they get some extra oomph. So either it's a straight up combination, or maybe they use our model in edge cases, or maybe it adds more conviction when our model aligns with their thinking, or so forth. Or it could be, we do have some credit risk models that could help screen out the potential disasters, early warning signs, text mining, news, and broker research, and other things about if there could be a credit risk issue coming up. So we can only hypothesize how they use it, but they're using it because they keep buying from us. So.
And the main objective of the models, the specific ones that we will be talking about, the StarMine, kind of the core set of holdings models, is it to help investors to generate alpha and find differentiated opportunities?
Yeah, yeah, that's exactly it. I mean, the concept of a holdings model is not novel. I mean, most funds probably have some aspect of that. But what's unique about ours is our behavioral finance approach, which I'll get into. So, yeah, the ultimate goal is alpha through monitoring holdings, but with the extra layer of behavioral finance, trying to predict, what the active buy side likes now and what's attractive to them and where they're likely to, buy next.
Okay, so let's talk about that. So you recently released the newest model. I think it's called the StarMine Smart Holdings Plus model. So talk to us about that.
All right, so I should probably give a little bit of background about the original model because the plus is the addition. So the original model came out in 2011, kind of towards the early time of my career at StarMine. And it's a holding model. Its inputs are 13F filings and Lipper mutual fund holdings. But instead of we're different than regular holding models. Most holding models will see activity in a stock like IBM in the holdings data, and then make bets about what's going to happen to IBM going forward. We are not doing that at all. What we do is we create individual behavioral finance profiles for all the active, not the passive indexer, all active funds that we have ownership data for based on what they've bought in the past 3 months, net buys, and piecing together in the original model 25 traditional financial factors to say, are they favoring growth? Are they getting into value? What's motivating them? Um, it's like thousands of funds that are, 13 apps come out quarterly. The SEC requires them to, at least get their holdings published, the 35-day lag, which is what they tend to do. And the Lipper mutual funds are a little bit broader coverage than ones mandated by the 13 apps. So it's a really good set of data.
So you have you're looking at these active managers, and for the audience who are not as familiar, like what sort of how do you define active managers that will be part of your universe?
So, I'll define it by defining a passive manager. So, a passive manager is probably tracking an index like the S&P 500 or Russell 3000, or maybe, or maybe a more niche index. It's very rules based, whereas an active manager has more discretion. It's you kind of think of like, well, on an individual basis, kind of think of the hobbyist trader that's
Like
like
the retail
research.
investor, but these
Yeah,
are
yeah,
the active
yeah,
managers who have lots of they have a lot more asset under management.
yeah. So it's the same mindset, but these managers have millions, if not billions, under them. They're trained in this area, so it's a little bit more advanced than the retail, but the retail investor, but the mindset's the same. And that we're trying to really replicate what's going on in their heads. So, we have two components. There's the screening component where after we have all these profiles, we are looking across all the traded stocks, like around, 45,000 to 50,000 stocks. And kind of in a big matrix operation, we're saying, we're determining, does this stock seem attractive to this institutional investor's profile? And we do that across those thousands of institutional investors and those like 50,000 stocks. And ultimately, we get an aggregate attractiveness score for each stock about would this stock pass many screens of these managers based on what they're interested in. And then another phenomenon we're trying to replicate is the new idea phenomenon. So, if someone's managing a fund, let's say a value fund, they're probably well aware of all the stocks that are value stocks. And, they've either chosen to invest or chosen not to invest. But if suddenly a new stock becomes a value stock, maybe it had a price drop for whatever reason, but the fundamentals are still good, that's going to get a lot of attention. That's a potential new idea. And they're more likely to put money into a new idea than they are of something that's been on their radar for a long time. So that's our change component in that we give a little more juice to those new ideas. And in combination with our screening component, that's how you get the final rank of the smart holdings score in the original model.
Interesting. I was gonna ask you which stock that was either growth has become value, but we're gonna skip that question since we're
Yeah.
not doing picking stocks here. But now extend what you said about the original StarMine Star Smart Holdings model to the Plus model. What's being added since then?
So we realized that the motivation was that the landscape has changed a lot since 2011. It's still a very effective model with really good performance because it's so innovative. But what's changed? ESG investing. I know there's a little bit of a controversy around it right now in some parts of the world, in some political realms, but the reality is there's a lot of fund flows in sustainability funds. It's objective. It's not up for debate. Money's flowing in there. And we kind of approached it in the same way in that ESG is not an ideology to us, but another stock factor.
Hmm.
So we thought we could have a more robust model by integrating some ESG factors into the mix um, to enhance performance. And and we achieved that is the bottom line. But we were very quantitative about how we went around picking, what ESG factors we thought we should include in this new model.
So for those who are watching or listening, ESG stands for environment, social, and governance. And so, do you have factors or additional sort of features within each of those, or how did you consider parsing out the important elements under ESG to add to the holdings model?
Yeah. Well, I mean, it's one great thing is nowadays there is so much ESG data using the LSIG ESG. I think we have over 870 data points to choose from. And obviously, you can't throw all those into a model. That would just be insane. So we had a very quantitative approach to narrowing down what factors we would consider. And in general, people might be most aware of the top level ESG scores or maybe even the top pillar encapsulating just like environmental or just social. But we figured the more granular factors would be interesting to us. And for the most part, that was true. So when differentiating stocks, I mean, whether you're looking at a value ratio or looking at an ESG factor, you really want a robust numerical distribution. So, coverage was big. Niche factors like chemical weapon revenue. I mean, sure, that's important to investors, but not many companies are going to have that data, so it's not a good choice. And similarly, binary factors like does this company sell tobacco, yes or no, that's not helpful as well. And then even the whole like arithmetic term mode was about useful now. That's when one number is overrepresented. So some of the governance factors, especially like litigation expenses, is often zero. So that's not a good factor as well. So there was a lot of screening, and then so there was a lot of screening to get down to what could be useful. And then we did more advanced analysis, like cluster analysis. So one thing you don't want in a quant model, or actually even outside of the finance space, is just um, a lot of input variables that are highly correlated, because then you're just going to be capturing the same thing, essence, many times over, which is not what you want. So we did some correlation cluster analysis, and then we found things like CO2 was highly correlated to SOX and NOx, which makes sense. And using our own expertise, like my familiarity with the area, talking to some of our ESG experts internally, we would choose the most representative, like CO2. And then normalization was important because many factors had flavors like, the raw CO2 output or the CO2 divided by revenue. So it's normalized across companies. So we would go with the ones that are normalized. And then finally, as we had a smaller candidate pool, it was just straight up quant back testing. If we add these factors, does it improve performance? Performance being a decile spread, a long, short investment over a month-long period, rebalanced, and so forth. So yeah, it was a rigorous process. We got down to 13 factors at the end that really enhanced performance.
So you talked about back testing,
Hmm.
and that when we think about building models and data science and AI, a huge part is be able to validate the models to see whether it's performing to expectation, to meet the metrics, and tell people a little bit more, especially for those who are not as familiar with back testing. Why is that important? And how do you determine after validating your model that this is good enough, this is robust, and it's ready to be shipped and distributed to clients?
Sure. Well, I mean, I think maybe let's think about the clients at first. At some point, they're going to be trading real money, and they don't want to lose the money. They want to make money. And so they want to simulate before they go live how well this model would perform. Um, so for them, point in timeness is extremely important. That means can they replicate the past, like like it will be going forward. And before I get into the actual performance metrics, I really want to emphasize point in time because in our research at StarMine, we're so careful about that. And we were very pleased to have the robust ESG point in time content set.
But tell
So,
people more about that, Adam. Like,
yeah.
what does it mean, like point in time? Do you mean the data quality, or just at any given point in time, you look at the performance of the model using the updated holdings relative to the older model? There is a clear difference in performance at any point of time.
Yeah, so well, let's think about how ESG data flows. It could be considered slow data in the sense that most companies publish it yearly, but they never don't publish it on the same date. So you always have to be, different companies will report on different dates. So you need to reconstruct the exact date that the company reported because that's when it was known to market participants. And also, kind of like with the financial world, there can be restatements. Companies all of a sudden are like, oops, I published the wrong revenue. Here's the correction. The same thing happens with the sustainability reports as well. The CO2 emissions could be updated once or twice, and you need to recreate how that happened because going forward, each day is a new day and, new company reports or this company revises. So you need to simulate that history. So that's what the point in time of the input data is like, which means, and we want to construct our historical research pack, as we call it, using the algorithm on old historic data the same way so that people can be confident that going forward, our model is going to perform the same way. And one really great thing about this model is that my research locked down at the end of Q1 2021. So we actually have a lot of out of sample data in the
Yeah.
sense that performs well. But some clients will basically also take the technique of buying the data feed and kind of letting it run forward in a paper environment, not trading real money to see how it does.
Yeah.
So they can be really sure that there's no flaws in the research pack just by
Yeah.
hooking into the live. And as for the performance metrics, I mean, it's really hard. Every client's going to have a different use case about how they're going to trade this. So we try to take a more approach that could give enough information to interested clients in the sense that we think about monthly rebalance periods. Each month we reevaluate what we're holding, and we tend to simulate the long short strategy. So that would be in a given universe, usually a universe that doesn't include micro caps because they have all sorts of liquidity constraints. We simulate buying the top decile, the top 10%, and shorting the bottom decile in a market neutral approach. And then going forward, we'll have metrics like, what's the cumulative return over a long period of time, what's the annualized return, Sharpe ratios, ICs, max drawdowns. Really, all these numbers are to give confidence to potential clients so that they then will be interested enough to trial the data and see if it works in their own strategy. I mean, we don't have the nuances of market impact or transaction cost because many people approach it different ways.
Yeah. And they may be using different benchmark internally and
Yeah,
different things. So this is really to compare to the smart holdings model versus the holdings plus model and looking at that spread in the return performance.
yeah, and one of the other ways we show it is we'll also show the long decile separate from the short decile alongside an equal weight of whatever universe we're looking at. So that could show, what you want to see in that case is the long top decile being much better, much higher than the midpoint, and same with the short being much lower than the midpoint, to really show that we're doing a good job of differentiating stocks on our relative bearish to bullish ranking. And and that's also a case for long investors too. Not everyone's a long short. So if they can see the top decile doing well over time compared to an equal weighted benchmark, then, they could be confident in wanting to try out our model.
Yeah. So one of the things, Adam, as you know, in machine learning and data science is talking about model freshness and robustness. And so you talked about the smart holdings model that came out in 2011, which is 14 years ago, and is still, one of the leading models in industry, widely used model in the industry. And the Holdings Plus model, you finished developing that sometime in 2011. So you have 4 years presumably out of sample, or at least 3 years of out of sample data. Um, how do you determine whether a model is still fresh? Like meaning, there is no model, there is no really in general, like data drift or model drift or concept drift, and that the model is still relevant and performant for a particular use case. We don't have to talk about the smart holdings model necessarily, but just in your experience as someone who built these trusted models for enterprise institutional clients. Like, how do you think about this concept of model freshness? When do you keep the model in the market, and when do you sort of take it offline and replace with something else, which relate to model robustness as well?
So for our alpha models, we actually have a monthly performance report that is, published externally. Anyone can get it on the website if they sign up. Actually, I don't think they even need to sign up to access it. And that's where we kind of what I described the back testing, where when we launch a model, we'll look at a decade or two of performance. But in this report, we look at the past month and the past trailing 12 months. And we look across many different regions. So, I mean, with factor investing, it's never going to be the case that one factor is always working across all of the regions across all time. I mean, just think about the whole value versus growth. But what, we do, I mean, I think it would raise some red flags if a certain model was underperforming all the time, and we
Yeah.
haven't seen that. And also when we're talking to a client trying to get them to do a trial. We may do a custom back test for them on the universe that they care about, which may be different from what's in our reports or in the white paper. So those are ways that we keep an eye on the performance of our alpha models. And what clients actually like is the consistency. I mean, we have our research pack, we have the go forward live data also archived, and they don't want us just changing the algorithm under their feet because, I mean, they've done their own robust back testing before they choose to use our model in their investment process. And that would be a very unwelcome variable for us to just change that without telling them. So we don't do that. And I think that's appreciated.
Yeah. Yeah, that's really good to know. So switching gears, talking about large language models, since
Yeah.
that's what kind of everybody's looking at,
Hmm.
Gen AI.
Yeah.
Um, how do you think the Gen AI and large language models like will change financial analytics? What are the opportunities that you're most excited about?
Well, first, I should probably mention that at StarMine, we were working with LLMs before it was cool. Really, I mean, we
Yeah,
came out also in I think maybe 2012. We came out with our text mining credit risk model, which looked at four text sources: news, financial filings, transcripts of earnings calls, and broker research to look for foreshadowing of company default in the next year. That was using Bag of Words, which is similar to Naive Bayes. A few years back, we did an M&A target prediction model, which used BERT. Kind of that was BERT that was trained on Reuters News and then fine-tuned on acquisition events within the next
yeah,
year. Also, and that was married with text too. So it's nothing new, the LLMs, but I think it's, with this particular flavor of Gen AI, I think it's a little different this time. I mean, I don't think anyone's at the place where they're just gonna delegate control to a Gen AI model to make investment decisions. However, the most immediate use case is helping humans, the equity analyst, sift through all this data and make sense of it. Like I did a little I managed some equity analysts in addition to quants researchers, and I did a Gen AI prototype for them to parse out tariff exposure, country supplier percentages mentioned in transcripts, so that they can then be aware of that when they're writing their own research reports. So I think stage one is to really identify the cases of where are the humans overwhelmed with all this data and how could Gen AI help with that. And then maybe when you become confident with that, that could be an input into a quant model. But I still don't see yet, thinking ChatGPT is just going to invest, for my pension fund. I don't think we're there.
Yeah. Well, also explainability is a
Yeah.
big consideration and trust. And as you talked about, I mean, it's a different sort of genre of models,
Yeah.
but smart holdings category of models, the factors. I mean, it's not a black box, right? Whereas can't say the same thing if you were to apply a large language model to make those decisions.
Well, actually, I think for what I've been using it for, I think it's very possible. Like, if your LLM says, "Oh, this company gets 20% of its goods from imported from China," um, you could actually do some regular expressions or maybe even human validation to say, "Oh, does that actually exist in the earnings call transcript where someone mentioned it? Is it true?" And there's your answer. I
Yeah,
mean, it's a lot different than, I would never have an LLM right now trade money for me and, trying to have it explain why I made that stock decision. That's different from saying, hey, I'm interested in this bit of data distilled from this large bit of data. Show me how you got to it. Show me the quote, and then I can have my own checks to see if that's right. And it can always fall back on human validation too if you're still trying to gain confidence in how you're using Gen AI in one of those use cases.
yeah, absolutely. Last question. Advice for emerging data scientists and AI engineers and people who want to become quants. Like, what are the skills that you would uh, advise them to build, given where we are in AI?
I mean, I think the real tactic is to be fresh on whatever the latest developments are in that field, and not just knowing it from, not reading a paper and summarizing a paper, but actually being able to apply it
Yeah,
in use cases and so forth. Because you think about it, whenever you join the workforce, you're going to be joining with a lot of experienced people that are quite experienced in all the technologies that came before now. So, do you really want to? You don't really want to dive into R and all those statistical packages that have been around for decades. You want to dive into the hottest technologies and with a mindset on how can they be applied to the use cases in the field that I'm entering. And to show some demonstration to that, but also to have the humility to know that, you're new to this and, you don't know all the answers, but with the right guidance, with someone with the experience, you could use the new technology, new skills to get to those answers. And even for those of us with experience, we don't know everything. We need that humility too, because
exactly. Yeah,
so
I
yeah,
love that about you, Adam. It's like you
yeah.
actually know so much, but you always have that humility with you. But I agree with always keep learning and getting in that hands-on skill and be able to apply that in the right use cases and also learn from others along the way. Well, Adam, thank you so much for your time for share more about your latest launch of this Smart Holdings Plus model and talking more about your work.
Well, great. Thanks for having me, Joyce. It's always so good to chit chat about this fun stuff. I mean, I really love geeking out about quant and AI. So yeah, this has been great.